We're actually going to have Brian show some of the charts that he uses because the anchored VWAP is so important to him. Of course, that's the volume weighted average price. And as he's talking about his different timeframes that he looks at, we'll also kind of get his thoughts on that. So Brian, let's just start out. You mentioned we were looking at daily charts. What is your favorite time frame to look at, or do you have a favorite?
Yeah, I don't have a favorite really. It's kind of all of them. I've
love all your
explained.
children the same, huh?
Well, it's kind of, I described this once. I think it was with Richard Moglen that he asked kind of the same question, and I said that's kind of like asking Van Gogh what's your favorite color to paint with, and he would probably say, I don't have a blue canvas somewhere. It's I use them all, and it's how they weave together, and we look at one time frame or even all the time frames. It's the science of technical analysis, but then it's the art of interpretation and how they blend together so that we can reference that shorter term time frame, see how it fits in with the longer term time frame, and try to anticipate what's going on. So it's really a combination of how they weave and flow together.
Yeah. So now you're moving average lines. I mean, we've talked a lot about the 50-day. You mentioned the 200-day moving average line, but a lot of times for your trades, and a lot of times you're doing these swing trades, the 5-day moving average line seems to be kind of your go-to moving average. Is that right, or do you have others that you're weaving a palette with there too?
Well, I'm kind of weaving the palette there. So I'm interested in the 20-day moving average. I'm interested in the 50-day. I generally want to trade in the direction of those. I want them, if they're both rising and we're above the markets, or the stock is above those, then I want to give the benefit of the doubt to the buyers, and ideally the 200 as well. But when it comes down to entries, I guess those would kind of be my favorite time frames. Would be maybe a 30-minute time frame or a 15-minute time frame, so I can get a feel for what are the time frames that I'm typically trading. That if my swing trade is anywhere 2 to 3 days up to a couple weeks, I'm going to see those on that 30-minute time frame, on that 50-minute, 15-minute, or 65-minute time frame. Those allow me to see the key levels, and that's where I look at the 5-day moving average. To me, I've got a cardinal rule, which is if the 5-day moving average is declining, I just am not going to buy it. If it's advancing, I simply will not sell short. I'll wait. And that has saved me more money than anything that I have done in my career. As far as, getting the proper entries. And the proper entry to me is, where can I get involved with confidence and get as big a position size as I'm comfortable with relative to where I perceive the risk rather. So those shorter term timeframes are what gives me that confidence.
And just so folks know, just again, kind of your trading style, what is kind of your position size sweet spot? Do you are you a lot of positions, or are you much more concentrated? How high do you get that?
It tends to be a lot more concentrated, simply because if I'm not concentrated, then I just tend to have large piles of cash in my account sitting there doing nothing. So with my time frame, there's a lot of turnover, and that doesn't give me a lot of time to, hold things that aren't working. If they stop working on a shorter term time frame, I get out. So a lot of times I'll be very cash heavy, as I am right now. And it's each stock on its own merits. I never think, well, I have to be at least 60% invested because of this interest rate or whatever. It's always about stocks on their own merits. And I even still, I struggle with being large enough relative to the size of the account, simply, because of liquidity issues sometimes. But I try to stick to stocks that trade at least 500,000 shares a day. And then just comfort level, truthfully.
Right.
Okay. So Brian, you have the 65-minute chart here. So so walk us through this, and you have the SMA, Sean, right? So walk us through kind of example of how you'll use a number of different time frames to analyze a stock or ETF.
Sure. Let's look first just at this 65-minute, because we're here. And just a quick reminder for people who aren't familiar with this, why do I use a 65 rather than a 60. 60, there's 390 minutes per trading day. If you divide that by 6, it's 65. 65 times 60 is 390. If we were looking at 60-minute candles, it would be 9:30 to 10 is one candle, and then a 1 hour, so 1 half-hour candle and 6 1-hour candles. Well, anytime you put a moving average, a stochastic, whatever it is, you're giving twice as much weight to that first period of the day, which doesn't really, that's too arbitrary. We're not really comparing apples to apples. So with what I'm looking for is what I really want to find is, when it's below this declining 5-day moving average, that's when I have a short bias or I won't trade long. So right now we dipped below the 5-day moving average, but it was still rising. That's kind of like a yellow light. It gets trapped below it and makes a lower low. That right there, the light turned red on the semiconductors for me right there. Now back to here, we were below this declining 5-day moving average. It tried to get going, but it didn't break resistance as well. So had it broken that resistance, that would have dragged that 5-day moving average higher. I would have wanted to be long here with a stop under there. Instead, it broke down, made lower highs and lower lows. The 5-day moving average was still declining. I wasn't going to be a buyer here. So, because it had gone too far too fast. And instead, I would want to be a buyer somewhere over here, maybe with a stop under that, and then raise my stop underneath these successive higher lows and be stopped out maybe right there. And then, so that's how I use the 5-day moving average. So on this 65-minute time frame, as you see up here, it says moving average is 30. The 30 period. So what that means is it's the 30 period moving average. So again, 390 minutes in a day times 5 days is 1,950 minutes over the course of 5 days. So while, I never look at the 5-day moving average on the daily chart, because if we look at it, let's say 2 hours into the day, what we're actually looking at is the average of the last 4 days plus 2 hours. I always want to know the true 5 days. So this dot right here, and I on most of the time I have that actually as a dotted line like this. What that does is that shows me where we were 30 periods ago. So what that allows me to do is to start to anticipate. So I look at this and say, well, tomorrow we're going to get rid of this data from 5 days ago. So that means the market would have to be way up here for that 5-day moving average to turn higher. And how likely is that? And if that did happen, would I want to buy it at 151 after it just closed at 146? Not likely. Not when we have this pattern of lower highs and lower lows as well. So it all fits into that. So going back to the calculation, 30 of these 65-minute periods is how many we have in 5 days. Because again, there's 6 of them per day, 5 days. So that's the 30 period moving average. If we cut our time frame down to a 30-minute time frame, let me just clean some of that stuff up. We can, again, I'll just get rid of that anchor as well. Here's the same thing. And you'll see that moving average is in the same exact spot as it is over here on that 65-minute time frame. So in order to do that, what we're looking at is how many, we take 1,950 minutes that there are in 5 trading days and divide that by the time period we're looking at. So we're looking at a 30-minute period. So how many 30-minute periods are in 1,950 minutes? And that answer is 65, just the opposite of what we were just looking at. Now, if I want to get a little bit more detailed and go down to a 15-minute time frame, we've got to do another adjustment, because now we're looking at this and saying, how many of those, well, let's do a 10-minute time frame just because it's simpler math. Again, 1,950 minutes. If the time frame is 10 minutes, then this 5-day moving average here, you'll see, is the 195 period. 195 times 10 is 1,950 minutes. That's the true 5 days. If we're looking at a daily time frame, it would only be a true 5 days at the end of the day. So I want to try to anticipate how this 5-day moving average turns. So then I start to look at this in my, the way I look at this is I start to try to anticipate what's going to make this move. So what might be the next way that we get a move higher? Well, maybe the 5-day moving average does this, while the stock, semis maybe do that, come down like this. And then in 4 or 5 days, then we'd be getting rid of this data, let's say on that day. So I'd be a little hesitant because later in the day, we're getting rid of that, which means the 5-day moving average would decline. So maybe it does this. And then I would want to be a buyer right here with a stop under one of these higher lows is the way that I want to look for the next potential upcycle. But then going back to multiple timeframes, does that look realistic on the daily time frame? Or because right now, here's the anchor from this recent low. We're below that. We've got a declining 50-day moving average. We've got a flat 20-day moving average. The 200 and the year to date are down there. So again, it's about how they all weave together and what's most realistic. So I can't just say this is my most important time frame. These become the more important time frames when it's time to execute the trade. But to find the big picture, to make sure I'm on the right side of the the bigger trend, then I've got to understand those first to come down here where I can say, well, it's below the declining 5-day moving average. It can reverse suddenly like it did here, but it's not the way it typically works. So if we go to a 130-minute time frame, and this is kind of a little bit dorky maybe, because here I've got a 5, 10, and 20-day moving average, and I've done the same math. So there's 3 candles per day on a 130-minute. So this 20-day moving average is actually 60 periods.
Okay.
So so I've got the 5, 10, and 20 over there. And that's kind of, now I'm looking at this thinking, well, shoot, these got these lower highs and these lower lows. Is this thing ready for a bigger breakdown? Maybe, the people who are still waiting for this gap to get filled before they buy, maybe they're going to get their chance over here.